Question 1. A producer expects to harvest a large corn crop in 4 months and is concerned that corn prices may decline by then. To protect against this risk, the producer would most likely A. Buy corn futures contracts. B. Sell corn futures contracts. C. Buy corn call options. D. Sell corn put options. Answer: B. Sell corn futures contracts. The producer is a hedger concerned about falling prices for a commodity they will produce in the future, which is known as a short hedge. To protect against a price decline, the producer would sell futures contracts today, effectively locking in a price for their future crop. This strategy offsets potential losses in the cash market with gains in the futures market if prices fall. Remember, a short hedger is someone who has a physical commodity or expects to produce it and wants to protect against a price decrease. Question 2. Which of the following best describes the role of the National Futures Association, NFA? A. To execute customer orders on futures exchanges. B. To act as the central clearinghouse for all futures transactions. C. To provide a regulatory oversight and self-regulatory function for the U.S. futures industry. D. To set price limits for all commodity futures contracts. Answer: C. To provide a regulatory oversight and self-regulatory function for the U.S. futures industry. The National Futures Association, NFA, is the self-regulatory organization, SRO, for the U.S. futures industry, operating under the oversight of the Commodity Futures Trading Commission, CFTC. Its primary role is to protect market integrity and safeguard customers by enforcing ethical standards and rules among its members, which include futures commission merchants, FCMs, and introducing brokers, IBs. Think of the NFA as the first line of defense in ensuring fair practices and protecting investors in the futures markets. Question 3. An investor anticipates a significant increase in the volatility of a commodity's price but is unsure of the direction. Which option strategy would be most appropriate? A. Long straddle. B. Short straddle. C. Long call. D. Short put. Answer: A. Long straddle. A long straddle involves buying both a call option and a put option with the same strike price and expiration date on the same underlying commodity futures contract. This strategy profits from significant price movement in either direction, as the gain from one leg of the straddle will outweigh the combined cost of both premiums if the price moves substantially. When you expect high volatility but no clear direction, a long straddle allows you to capitalize on that uncertainty. Remember, a straddle is a volatility play. Long straddles profit from increased volatility, while short straddles profit from decreased volatility. Question 4. What is the primary purpose of a futures commission merchant, FCM? A. To provide investment advice to commodity pool operators. B. To solicit and accept orders for futures and options on futures, and to accept money or other assets from customers to support such orders. C. To manage discretionary commodity accounts for retail investors. D. To act as an intermediary between a hedger and a speculator, without handling customer funds. Answer: B. To solicit and accept orders for futures and options on futures, and to accept money or other assets from customers to support such orders. A futures commission merchant, FCM, is a firm or person that solicits or accepts orders for futures contracts or options on futures and accepts money or other assets from customers to margin such trades. FCMs are critical to the futures market, acting as the primary point of contact for individual and institutional traders, similar to a brokerage firm in the securities market. Their ability to handle customer funds and execute orders makes them central players in the clearing process. Question 5. The total number of open futures contracts that have not yet been offset or delivered is known as A. Trading volume. B. Open interest. C. Spot price. D. Basis. Answer: B. Open interest. Open interest refers to the total number of futures or options contracts that have been entered into and not yet offset by an opposing transaction or fulfilled by delivery. It represents the total number of open positions in a market and is an important indicator of market liquidity and the flow of money into or out of a futures market. Unlike trading volume, which counts the number of contracts traded, open interest counts the number of contracts currently held open. Question 6. A speculator believes that the price of crude oil futures will increase significantly in the near future. Which action would they most likely take? A. Sell crude oil futures contracts. B. Buy crude oil futures contracts. C. Buy crude oil put options. D. Sell crude oil call options. Answer: B. Buy crude oil futures contracts. If a speculator believes the price of crude oil futures will increase, they would take a long position by buying crude oil futures contracts. This action allows them to profit if the price indeed rises, as they can then sell the contracts at a higher price or offset their position for a gain. Speculators aim to profit from anticipating market price movements, and going long is the classic strategy for an anticipated price increase. Question 7. Which of the following is responsible for setting daily price limits for commodity futures contracts? A. The Commodity Futures Trading Commission, CFTC. B. The National Futures Association, NFA. C. The Individual Futures Exchanges. D. The U.S. Department of Agriculture, USDA. Answer: C. The Individual Futures Exchanges. Futures exchanges, such as the CME Group, are responsible for establishing and enforcing daily price limits for the contracts traded on their platforms. Price limits are the maximum permissible price range for a futures contract in a single trading session, designed to prevent excessive price volatility and maintain orderly markets. While the CFTC oversees the exchanges, the actual setting of these operational rules is delegated to the exchanges themselves. Question 8. An investor purchases a heating oil futures contract. If the price of heating oil falls below the purchase price, the investor may receive A. Maintenance margin call. B. Initial margin call. C. Performance bond refund. D. Settlement gain. Answer: A. Maintenance margin call. When an investor holds a futures contract and the market moves against their position, their margin account balance may fall below the maintenance margin level. If this occurs, the investor will receive a maintenance margin call, requiring them to deposit additional funds to bring their account back up to the initial margin level. This mechanism ensures that traders have sufficient funds to cover potential losses and maintain market integrity. Question 9. What term describes a situation where the cash price of a commodity is higher than the futures price? A. Contango. B. Backwardation. C. Inverted market. D. Normal market. Answer: B. Backwardation. Backwardation, also known as an inverted market, occurs when the current cash, or spot, price of a commodity is higher than the price of a futures contract for a future delivery month. This often signals a perception of current supply shortages or high immediate demand for the commodity. In contrast, contango is when futures prices are higher than the current spot price, which is considered a more typical market condition. Question 10. A registered associated person, AP, handling customer accounts must always prioritize: A. Maximizing commission revenue for their firm. B. Ensuring the suitability of recommendations for the customer. C. Encouraging frequent trading to generate volume. D. Providing only proprietary research to customers. Answer: B. Ensuring the suitability of recommendations for the customer. A core ethical and regulatory responsibility for any registered associated person, AP, is to ensure that all recommendations made to a customer are suitable for that customer, based on their financial situation, investment objectives, and risk tolerance. This suitability obligation protects investors from being placed into inappropriate or overly risky positions. Prioritizing suitability over other factors like commission generation is fundamental to ethical conduct in the futures industry. Question 11. Which of the following statements regarding the physical delivery of a futures contract is most accurate? A. Physical delivery occurs for the vast majority of all futures contracts. B. Delivery takes place only on the last trading day of the contract. C. The delivery process is typically handled by the clearing organization. D. The party taking physical delivery must be the buyer of record on the last trading day. Answer: C. The delivery process is typically handled by the clearing organization. While physical delivery is an option for some futures contracts, the vast majority are offset before expiration. For those that do proceed to delivery, the clearing organization plays a crucial role in managing the delivery process, including assigning sellers, those with a short position, to buyers, those with a long position, who intend to take delivery. The clearing organization ensures that the obligations of both parties are met efficiently and securely. Question 12. A company that uses futures contracts to hedge its exposure to commodity price fluctuations is primarily seeking to A. Speculate on future price movements to earn a profit. B. Minimize or offset the risk of adverse price changes in its cash market activities. C. Arbitrage price differences between various markets. D. Increase its overall market exposure for greater returns. Answer: B. Minimize or offset the risk of adverse price changes in its cash market activities. Hedging is the practice of using futures contracts to reduce or offset the risk of adverse price movements in an underlying physical commodity or cash position. Companies use hedging to achieve price stability for their raw materials or finished products, allowing them to better manage their costs and revenues. The goal of a hedger is risk reduction, not profit maximization from futures trading itself. Question 13. What is the function of a clearing organization in the futures market? A. To provide investment advice to futures traders. B. To solicit and execute customer orders on behalf of futures commission merchants. C. To act as a guarantor for every trade, ensuring financial integrity and contract performance. D. To enforce NFA rules and regulations among its members. Answer: C. To act as a guarantor for every trade, ensuring financial integrity and contract performance. A clearing organization, often referred to as a clearinghouse, acts as the buyer to every seller and the seller to every buyer in the futures market. This central role ensures that both parties to a futures contract are protected from default, as the clearinghouse guarantees performance on all cleared contracts. By interposing itself between buyers and sellers, it significantly reduces counterparty risk and maintains market stability. Question 14. An introducing broker, IB, generally differs from a futures commission merchant, FCM, in that an IB A. May only execute orders for proprietary accounts. B. Cannot accept money, securities, or property from customers to margin trades. C. Is not required to be registered with the CFTC. D. Can act as a principal in futures transactions with customers. Answer: B. Cannot accept money, securities, or property from customers to margin trades. An introducing broker, IB, solicits or accepts orders for futures or options on futures contracts but does not accept money or other assets from customers to margin those trades. Instead, IBs typically introduce customer accounts to an FCM, which then handles the customer funds and clearing functions. This distinction is crucial for understanding the operational differences between these two types of market participants. Question 15. The concept of mark-to-market in futures trading refers to A. The process of setting new daily price limits. B. Adjusting the value of a futures position daily to reflect current market prices. C. The procedure for physically delivering a commodity. D. The initial margin requirement for new positions. Answer: B. Adjusting the value of a futures position daily to reflect current market prices. Mark-to-market is the daily process of adjusting the value of a futures position to reflect gains or losses based on the closing price of the futures contract. This ensures that profits and losses are realized daily, and margin accounts are credited or debited accordingly, maintaining financial integrity in the futures market. This daily settlement prevents large accumulations of losses and reduces counterparty risk. Question 16. What is the primary risk for a seller of a call option on a futures contract? A. The futures price decreases significantly. B. The futures price remains unchanged. C. The futures price increases significantly, leading to potential unlimited loss. D. The option premium increases. Answer: C. The futures price increases significantly, leading to potential unlimited loss. A seller, writer, of a call option receives a premium in exchange for the obligation to sell the underlying futures contract if the buyer exercises the option. If the futures price rises significantly above the strike price, the seller of the call option faces substantial, theoretically unlimited losses, as they would have to acquire the futures contract at a high market price to fulfill their obligation. Remember, selling naked calls carries significant risk due to potential unlimited upside movement of the underlying. Question 17. The term basis in futures trading refers to A. The spread between the current price of two different commodity contracts. B. The difference between the cash, spot, price of a commodity and its futures price. C. The minimum acceptable price fluctuation for a futures contract. D. The amount of initial margin required to open a futures position. Answer: B. The difference between the cash, spot, price of a commodity and its futures price. Basis is defined as the difference between the current cash, or spot, price of a commodity and the price of a specific futures contract for that commodity. Understanding basis is crucial for hedgers, as they aim to minimize basis risk, the risk that the basis will change unpredictably between the time a hedge is placed and when it is lifted. Basis can be positive or negative, reflecting market conditions and carrying costs. Question 18. An investor opens a new commodity pool. This pool is generally considered a type of A. Managed account. B. Hedge fund. C. Collective investment vehicle. D. Broker-dealer. Answer: C. Collective investment vehicle. A commodity pool is a collective investment vehicle where funds from multiple investors are combined and used to trade commodity futures, options on futures, and other related instruments. Participants in a commodity pool gain exposure to the commodity markets without directly trading futures themselves, and the pool's assets are managed by a commodity pool operator, CPO. It is similar in concept to a mutual fund but specifically for commodity investments. Question 19. If a trader places a buy stop order for a futures contract, it will be triggered when the market price A. Rises to or above the stop price. B. Falls to or below the stop price. C. Matches the current market price exactly. D. Is 10 ticks below the current market price. Answer: A. Rises to or above the stop price. A buy stop order is placed above the current market price and becomes a market order when the contract's price rises to or passes through the specified stop price. Traders typically use buy stop orders to limit losses on a short position or to protect a profit on a long position by entering the market when a price trend is confirmed. It's a key tool for managing risk and executing trading strategies based on price momentum. Question 20. Which regulatory body has primary jurisdiction over the commodity futures and options markets in the United States? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The Commodity Futures Trading Commission, CFTC. D. The Federal Reserve Board, FRB. Answer: C. The Commodity Futures Trading Commission, CFTC. The Commodity Futures Trading Commission, CFTC, is the independent federal agency that regulates the U.S. commodity futures, options, and swaps markets. Its mission is to foster open, transparent, competitive, and financially sound markets, and to protect market users and the public from fraud, manipulation, and abusive practices. The CFTC is the primary governmental authority for oversight of these specific financial instruments. Question 21. What constitutes a discretionary account in the context of futures trading? A. An account where the customer approves every trade before execution. B. An account where the broker is authorized to make trading decisions without specific customer approval for each trade. C. An account used exclusively for hedging purposes. D. An account that only trades options on futures, not futures contracts themselves. Answer: B. An account where the broker is authorized to make trading decisions without specific customer approval for each trade. A discretionary account is one where the customer has given written authorization to a broker, typically a commodity trading advisor or a futures commission merchant, to make trading decisions on their behalf without needing prior approval for each specific trade. Due to the significant trust involved and the potential for abuse, discretionary accounts are subject to strict regulatory oversight and specific rules, such as requiring written authorization and regular review. Question 22. A customer complaint alleging unauthorized trading in a futures account must be reported to the NFA if it involves A. Any trade executed without the customer's prior approval. B. Only trades resulting in significant financial loss to the customer. C. Only trades in options on futures, not futures contracts. D. Only trades executed by a commodity trading advisor. Answer: A. Any trade executed without the customer's prior approval. Unauthorized trading occurs when an associated person, AP, or firm executes trades in a customer's account without explicit permission, unless the account is discretionary and proper authorization is on file. Any complaint alleging unauthorized trading, regardless of profit or loss, is a serious violation of NFA rules and must be reported and investigated. This protects the integrity of the market and ensures customers' instructions are always followed. Question 23. An investor executes a bear spread strategy using options on futures. This strategy suggests the investor anticipates the underlying futures price will A. Increase significantly. B. Decrease. C. Remain stable. D. Become highly volatile. Answer: B. Decrease. A bear spread strategy in options on futures is designed to profit from a decline in the price of the underlying futures contract. This typically involves buying one option and selling another option with a different strike price or expiration date, limiting both potential profit and loss. For example, a bear call spread involves selling a lower strike call and buying a higher strike call, or a bear put spread involves buying a higher strike put and selling a lower strike put. Question 24. What is the purpose of an exchange for physicals (EFP) transaction? A. To allow for the simultaneous exchange of a futures position for an equivalent cash position. B. To facilitate the automatic conversion of a futures contract to an option. C. To enable a trader to extend the expiration date of a futures contract. D. To adjust margin requirements for open futures positions. Answer: A. To allow for the simultaneous exchange of a futures position for an equivalent cash position. An exchange for physicals, EFP, also known as an against actuals, AA, or basis trade, allows participants to exchange a futures position for an equivalent cash, or physical, position off the exchange, provided certain conditions are met. This is particularly useful for commercial hedgers who wish to manage their physical inventory and futures exposure simultaneously, without exposing themselves to additional market risk during the exchange. It's a way to transfer existing exposure from the futures market to the cash market. Question 25. Which of the following best describes the fundamental difference between fundamental analysis and technical analysis in commodity markets? A. Fundamental analysis focuses on price patterns, while technical analysis focuses on supply and demand factors. B. Fundamental analysis examines underlying economic factors, while technical analysis studies past price and volume data. C. Fundamental analysis is used only by hedgers, while technical analysis is used only by speculators. D. Fundamental analysis predicts short-term movements, while technical analysis predicts long-term trends. Answer: B. Fundamental analysis examines underlying economic factors, while technical analysis studies past price and volume data. Fundamental analysis in commodity markets involves evaluating economic, supply, demand, weather, geopolitical, and other factors that influence the intrinsic value and future price of a commodity. In contrast, technical analysis focuses on studying past price movements, trading volume, and chart patterns to identify trends and predict future price behavior, without considering the underlying economic drivers. Both methods offer different perspectives for forecasting market direction.